Hi and welcome to Westpac's end of day report for Friday the 2nd of September. Well, there was really only one story in town today, and that was the US non-farm payrolls or jobs report for the month of August. In the lead up to the release of the number at 1:30 London time, European markets were already in negative territory as reports were coming through that various banks had been revising down their expectations for the extent of jobs growth in the US in August. I mean, our forecast, which was prepared some weeks ago, was for a 20,000 gain. In the end, even we were over-optimistic. The actual outcome was zero. There were no jobs found in the month of August, no new jobs. And that compared to a consensus amongst all the major forecasters of around 70,000. So it was a disappointing report. I'll run through some of the detail actually, just to give you a feel for what was in there. Retail jobs, construction jobs, factory jobs all fell. One-off factors that kind of boosted them in July, for example, the resumption of auto sales after some of the Japanese parts supply issues had been resolved. A similar story in electronics as well. That had lifted retail and factory employment in July, but that reversed in August. The figure was weighed down by a strike at Verizon, the telecommunications firm in the US. That may have shaved as much as 40-odd thousand off the report. But at the same time, a Minnesota state government shutdown in July, which pushed down employment in July, saw those workers return in August, about 22,000. So even if you take out those special factors, we at best saw employment rise by about 20,000. So on any measure, this was a very soft payrolls number. Unemployment was steady at 9.1%. That's determined by a separate survey. That separate survey actually has, over the last 3 months, jobs growth declining, or jobs declining at an average of about 51,000 a month, compared to a gain of about 68,000 a month in the 3 months March to May. And on the payrolls report, the current 3-month rate is something like, I haven't got the figure, it's something like 30-odd thousand, I think, a month, compared to something in well above 100,000 a month in the previous 3-month period. Well, don't quote me on those numbers exactly, I haven't got them in front of me, but certainly both the household survey of employment in America and the payroll survey of jobs are showing a significant slowdown in the labour market coming through now. Actually, next month, a week ahead of the release of the September payrolls report, we get the Bureau of Labour Statistics benchmark revision for the level of employment as at March 2011. That's based on tax records, where they basically count up everyone who's got a job in America. It's a universe count, and we think that universe count will reveal that the BLS has overestimated payroll employment by as much as 500,000 in the year to March 2011. So that could mean that the apparent strength that we saw in the labour market at the beginning of this year in the US, when we were seeing 200,000 plus jobs reported each month, may have been imaginary, just a figment of the statistician's imagination. It may never have been there. In the same way that GDP growth was slashed in benchmark revisions a month ago, I think we're about to see jobs growth slashed as well. Further evidence that the US economy is really struggling. Now, you'd expect, given all the talk about quantitative easing over the last few days, or you wouldn't be blamed for expecting that you'd see a positive reaction to this sort of weak news on the economy because of increased speculation that we'll get another round of quantitative easing. But it wasn't to be. It's still only 4 o'clock in London time. I'm doing this report a bit early, but as I speak, the Dow's down 2% today on this disappointing jobs news at 11,267. And European stocks have been absolutely hammered. I mean, we've got the FTSE down 2.4%, the French market's down 3.5%, German market's down 3.7%, and similar size losses in some of the other smaller markets as well. The other issue too, of course, is we're getting the trickle back of Europeans from holidays. We're hearing day after day about problems in the European banks. We've got the Greek budget issue coming up with the IMF examination of their books going on at the moment actually, and likely to reveal that yet again the Greeks haven't been paying their tax, and therefore they haven't met fully the austerity targets that they need to meet to ensure they get the next tranche of bailout funds. It's all turning pear-shaped in Europe. The US economy is looking very soft and stock markets don't like it at all. On the commodity markets at the end of the week then, we've got gold prices up 2.8%, $1,879 $1,880 an ounce, almost back at its record high. Prospect of further QE, inflationary, therefore you buy gold. Copper prices are down 1.5% today, and oil prices, where's crude? Crude oil, actually it's the worst performing of the 19 commodities I've got today, down 3%, $86 a barrel. Okay, that's it. Loads of Aussie data coming up next week. We've got the Reserve Bank board meeting, GDP, and various clues that feed into GDP, the job ads figures from our friends at ANZ, and so on. So plenty to focus on domestically next week. But this week, really, it was all about the US and Europe, and it wasn't good news. Okay, speak to you soon.